everyone, welcome back to my channel. My name is Diana. If you're new, welcome. If you haven't already seen some of my other videos, please, after you watch this one, check them out. On this channel, we talk about personal finance and money related matters. If these are topics that interest you, please consider subscribing. So today we're going to be talking about why you shouldn't keep your money in the bank and rather invest it, and how one major bank collapsed. Now, breaking news. One of the largest banks in the US, this wonderful country, has decided to close and file a Chapter 17 bankruptcy. Now, you may be wondering, how is that even possible? Aren't banks supposed to be one of the richest institutions? Aren't they supposed to house people's money? Well, the truth is that it actually boils down to how the money is being actively managed. Now, in most cases, when a customer deposits their hard-earned money, the bank does one or two things with the money. The first thing that they do is that they issue loans. And those loans are your mortgage loans, your car loans, your personal loans, your credit cards. So that's where the first half of the money is going. So the second half of the money, the bank is using it to buy assets. They're buying treasury bills and they're buying bonds. Now, just a bit of background on Silicon Valley Bank. So Silicon Valley Bank was actually ranked as the 16th largest bank in the United States. A lot of their customers were tech companies, small startup businesses, and venture capital firms. Now, if you don't know what a venture capital firm is, like the name implies, it's a firm that gives money to upcoming businesses. A lot of venture capital firms are private lenders, and like most people, they keep their money in the bank. The only difference is that their deposits are in the hundreds of millions. So to give you an example of who venture capitalists are, think of the show Shark Tank. I'm sure a lot of you have probably seen it. People like Mark Cuban and Kevin O'Leary, they are venture capitalists because they invest in small businesses. Now you can see that their money greatly affects the livelihood of those small startup businesses that they promised that they would fund their ventures. This is just an example of the type of clientele Silicon Valley Bank had as customers. So you can see how easy it would be for Silicon Valley to have around 200 billion in assets. Now here is where the financial downturn of Silicon Valley began. Now, just a little background on the financial banking system. So banks in the United States operate under the fractional reserve policy, also known as fractional reserve banking. Now, in this policy, banks are only required to keep a small fraction of your money inside the physical bank. And the reasoning behind that is that this helps to stimulate the economy. So what that meant was if you had deposited $1,000 into your savings account, the bank was only required to keep 10%, which is $100 of your money in the physical bank. The rest of your $900 would have been lent out. Now multiply all of the incoming deposits by the hundreds of millions. You can now see that it's easy for a bank to issue a loan with your money. Not only that, but whenever you open up an account with the bank, you are essentially agreeing that you're allowing the bank to borrow out your money. Now, the fractional reserve policy changed back in March 26th of 2020, where the previous rate was at 10% and it got reduced to 0%. So what that meant was that now the banks could actually lend 100% of your money. So that meant that if you had $1,000, the bank could lend all of your $1,000 away and only produce it when you asked for it. So in return for the banks borrowing your money, they have to pay you an interest rate. Now, no one sets the limit for how much the banks have to pay you. So for the standard savings account, the banks are only paying you 0.3%, which is a very low interest rate for your money. So if your money was just sitting in your savings account, that's how much interest you'd be accruing. Whereas the bank now takes your money and flips it. So for example, let's say you have $30,000 in the bank, just sitting in your savings, not doing anything. With an interest rate of 0.3%, the bank would only pay you $90. The same bank will take your money and flip it, charge the borrower 24%. 24% of $30,000 is $7,200. That meant that the bank just made $7,000 off of your money because you did nothing with it and it just sat there. That's the reason why I'm always stressing, if you have any little bit of money, don't let it just sit in your savings account. Let that money work for you. Invest that money so that you can also start earning interest. This is why I heavily believe in investing. You can invest in your 401k. You can max it out, your 403b. You can invest in the stock market. You can open up a money market. And my new favorite, you can open up an index universal life. The index universal life is actually going to ride on the waves of the stock market. Now, I'm going to be talking a little bit more about it in future videos to come, so look out for that. Back to Silicon Valley Bank. So what happened was inflation. The Federal Reserve kept increasing the interest rates. Between 2022 and 2023, the interest rates went up at least 8 times. So how significant is that, and what did that mean for business owners? As I previously mentioned earlier, a lot of the customers of Silicon Bank Valley, they were tech companies. And you know, with inflation, everything is expensive. So people are not buying. People are not spending their money. So tech companies now are not making any money. And now it's too expensive to borrow money because you're paying higher interest rates. So what a lot of the tech companies did was, instead of borrowing from the bank, they just did a withdrawal. Now, it wasn't only just tech companies. It was many other startups out there that needed liquid cash, but they couldn't afford the interest rates because of inflation. So a lot of them just started withdrawing money left and right. So as a result, these business owners were withdrawing money. And I mean several businesses. They were withdrawing money in the hundreds of millions. And remember what I mentioned earlier, that with the new fractional reserve policy, the bank didn't have to keep any of your money in the bank because the new reserve rate was at 0%. As a result, the banks just could not keep up with the withdrawal rates of the customers. The withdrawal rates of the customers was around $2.2 billion that the banks had to produce immediately. Silicon Valley Bank did not have it. People were asking for their money and they didn't have it. So they had to resort to another means of getting physical cash, which usually is the last resort when a bank sells their assets. In this case, Silicon Valley ended up selling off their government bonds, but they sold it at a loss. The current government bonds that Silicon Valley Bank had was around, the interest rate was around 1.79%. And they had the bonds in hundreds of millions. But the newer government bonds rate was around 3.9%. So because Silicon Valley's bonds at the time was significantly lower than the newer bond rates, they sold it at a loss. And this is due to the fact that the older bonds were less attractive to buyers. And the way government bonds rates are determined is actually based on the state of the economy. So in an economy that has a high interest rates, when the government increases the interest rates, the bonds naturally increase in value. They also generate a higher interest rates. But because Silicon Valley Bank at the time bought bonds where inflation really wasn't a thing and the rates were significantly less, that's why they lost their money. So Silicon Valley Bank ended up losing $1.8 billion on the bonds. Now, because they sold those bonds assets at a loss, they had to report it in their financial books. Now, in most cases, banks will not sell their bonds unless it's an absolute emergency. And in this case, the rate of customers asking for the money and the rate at which the bank was able to produce the money was what caused this ripple effect. And there are probably a lot of banks out there in the same shoes as Silicon Valley where their bond assets are probably in an unrealized loss. An unrealized loss is a loss that you have before you sell it. And then when you sell it, it becomes a realized loss. So in addition to selling their bonds, Silicon Valley needed to get more money. That was not enough. So the next thing that they did was they sold their common and preferred stocks. So if you watched in my previous videos when I talk about the things that affect the prices of the stock market, selling your stocks is one indication that will surely drop the price of your stock. So if enough people are selling stocks, the price is naturally going to drop. So in the case of Silicon Valley Bank stocks, the stocks dropped by 62% in one day. As a result of all these things that were going on, the venture capitalists, they got wind of what was going on. So what a lot of them did through fear and panic, they advised their shareholders to withdraw their money from the bank. But not only their shareholders, they also told similar companies to do the same as well through social media. As a result, the depositors attempted to withdraw $42 billion in one day from one bank. As a result of everything that was going on, the California Financial Protection and Innovation, DFPI, they got wind of what was going on and they saw that the bank was in serious trouble. They seized the bank and handed it over to the FDIC, the Federal Deposit Insurance Corporation. I mean, this got really bad for the fact that the FDIC had to get involved. And mind you, just a little background on the FDIC. The FDIC only insures up to $250,000 of your deposit. Now, as I mentioned before, the clients that Silicon Valley Bank had were millionaires. They had hundreds of millions in the bank, but the FDIC was only guaranteeing $250,000 of their money. So for example, if a person had 25 million at Silicon Valley Bank, they were only guaranteed $250,000 at the time. So that meant they were like literally receiving 1 cent for their money. But fortunately, the FDIC got authority from the Treasury to give everybody back 100% of their deposit. So that meant that all the people that had hundreds of millions in the bank would be able to get their money back. Because again, we're talking about small businesses, people who have to make payroll, people who have to run their business. All their money was tied up to this mess. And because of Silicon Valley drama, Signature Bank got wind of it. Their customers were running to the bank to also try to withdraw their money. Signature Bank also had similar assets like Silicon Valley Bank. And in order to prevent any future problems, Signature Bank was also handed over to FDIC and they were shut down. So to recap, a major bank that shut down in the 2008 recession was the Washington Mutual Bank. And that was one of the largest banks at the time. And now you have Silicon Valley Bank, which is the second largest bank to shut down in history. And right under that, you have Signature Bank. So guys, what does this mean? This means that if you cannot invest your own money, the banks are going to invest your money and they're going to make a decision about your own money. If we have learned anything about these banks, we have learned that it is very important to take ownership, to learn about investing, to learn about planning for our future, and to learn about diversifying our portfolio. You want to make sure that you have your money spread around different banks. And also, if you're opening up an account with any bank, you also want to make sure that that bank is FDIC insured. Because as you can see, FDIC had to bail out this bank in order for all of their customers to be able to get their money back. All right, guys. Well, I hope you certainly enjoyed this video as much as I enjoyed researching and talking about it. Just drop in the comment section and let me know what type of topics that you would like to see from this channel. Thank you, and I'll see you in the next one.